Will this be a summer for stocks to sizzle or slump with further Fed tightening on the horizon? Investors are on edge. Our next guest says, as we just heard, we should keep it light and tight this summer. We're bringing back in Tony Dwyer, Canaccord Genuity Chief Market Strategist. You just talked a little bit about, in your mind, what it means to be light and tight here in this difficult environment. Are there particular areas where you think people should be really ready to sort of deploy cash if something happens in the market?
Well, light and tight means light in exposure, meaning a little bit extra cash, and tight to the benchmark. Remember, we advise institutions in the U.S., many of them long only. So how you are relative to the benchmark is a major influence. And we would rather be tight to the benchmark versus excessively defensive, even though we have a recession call. So, Julie, we would suggest being right now a little bit more defensive in the healthcare, interest-sensitive areas, as well as, like I said, a little bit more fixed income exposure. But ultimately, you've got to have that short-term interest rate market come down. And that's when we're going to look to add into the cyclicals or those early cycle names when it becomes evident that there's a recession or a recession unfolding.
Tony, previously you've said you expect the S&P 500 to test its October lows by midsummer. Do you still have that expectation?
Well, that would be a hell of a drop from here in the next week. So no. Ultimately, I think there's going to be some more meaningful weakness. Whether we break the October lows, I think, is in question. If you go anywhere near it, it's a significant enough drop, I think, to change the sentiment. Again, if it's associated, whatever the drop is, Diane, associated with a short-term interest rate environment, that's really going to be the catalyst. It's not where the S&P is. Remember, as I said before, the S&P right now is being driven by a lot of 10 mega cap stocks, which comprise over 32% of the market capitalization of the index, higher than at any time since the early 1970s. So ultimately, it's not really where the S&P call is. It's where the rest of the market is, which has remained weak. A little bit more weakness coupled with a short-term interest rate drop is really going to be the catalyst to get us in the game.
Tony, I'm amazed that we've gotten to this point without talking about tech. But if you're sort of tight to the benchmarks, that effectively means that you have a decent-sized weighting in tech because of their weighting in the benchmark. Does that imply here you don't expect any maybe big outsized moves from here when it comes to tech?
I would have been light, underweight tech, and especially mega cap tech. And I think, again, Julie, I think that's where you have to look at the differentiation between the biggest stocks and the rest of the market. Like a lot of those software names and other areas of tech have not done anywhere near as well as the market cap weighted sector index. So again, I think it comes down to where are you exposed in tech, and I leave that up to the sector, strategists and experts. But at this point, I would still be underweight that area a little bit. But think about it, a lot. It's not just tech, it's consumer discretionary because you've got Amazon, it's communication services because you've got Meta and Alphabet. So we still talk about it like it's tech, but there's three sectors that are up more than 20% year to date when everything else is either flat or down.
And Tony, how do you play the balance of the year? You use your phrase, keeping it light and tight. Is that through the balance of the year, or is that just a summer play? There's often the phrase that the best defense is a good offense. So what's the offensive plan through the rest of the year?
Again, the offensive plan, Diane, is simply to be guided by short-term interest rates. If they start to come down dramatically, that's going to be an underpinning for the outlook for money, which will get us bullish. So it shouldn't be, guys, it shouldn't be based on a calendar date, an election year, a summer, a fall, a year. It is based on the tactical backdrop of how overbought or oversold we are on an intermediate term basis, coupled with the outlook for money, which is driven by short-term interest rates. So I'd love to tell you this is the entire plan for the rest of the year. If it unfolds in the next week, that's going to be the catalyst. And that's where, again, our strategy is to stand ready to take advantage of weakness versus betting on it when we're this far into it and the average stock simply hasn't performed anywhere near like the indices.
All right. We will have to put a pin in our conversation. Always great insight. Tony Dwyer, Canaccord Genuity, Chief Market Strategist. We appreciate you.